Mickey Dickey here. And one of the questions I get is what is a 1031 exchange? And Dave's got a nice example up here, and I'm going to run this little part of this video so you can get his opinion on it, and I'll add to it here in a second.
Property. So the situation right now is ideal, but again, I don't know if the market's going to continue to increase or if it's going to blow up and start declining in value.
Oh, I think it's going to go up in value. I don't, unless you've got a neighborhood problem. But overall, real estate, I don't think real estate as a category is going to go down.
Now, I love Dave's optimism here because, every time he talks about real estate, he talks about it as though it never goes down and everyone ever loses money on that. I understand he's talking about the fact that generally speaking, real estate does go up, but there are times, not just a specific neighborhood, but the entire market, and I'm just going back to '07 and '08, where this was a big downturn, and a lot of people lost a lot of money in real estate. But anyway.
Now,
Right.
certainly there are neighborhoods that deteriorate. Sometimes people let their property deteriorate, that kind of thing, but I'm not worried about that part of it. The only thing I know that you can do to avoid capital gains, if you choose now is the time to sell it for you, would be what's called a 1031 tax deferred exchange, and that would involve selling the property into an escrow account and buying another piece of real estate out of that escrow account. And it is in effect a trade, as if you've traded this property for another property, and so you roll your basis into the new property. And so if the new property's $550,000 or less, you're going to have zero basis in it. And
That's what I've
in the
heard.
new property. So you're not going to have anything you can depreciate unless you move up in property. And so you can buy $1 million property, but obviously you'd have to put up the money for the difference. And so you're getting further into the real estate business at that point, and it's just a matter of whether you want to do that or not. But for instance, if you wanted to buy 4 houses in San Antonio, $150,000 houses, you could do that.
What a 1031 exchange is if you have an income producing property. So this is not your main residence. This is not a second home that you've got somewhere. This has to be an income producing property. Now, it can be a second home that you have that you use for rental income, okay, but it actually has to be a rental income producing property. It can be farmland, it can be agricultural. There's a lot that can go into this as far as income producing. But it has to be income producing. So again, if you have a property that you bought 30 years ago, and in this case, he inherited a property and has been renting it out for many years, and now he doesn't want to be a landlord anymore. Okay, one option that he has is to take that 550 to go find another rental home. It doesn't have to be in the same market either, but keep that in mind. This is an IRS federal regulation, so that you can, if he doesn't live in San Antonio and he lives in California or he lives in Minnesota, it doesn't really matter, as long as he buys something similar, like kind, and moves on. So what Dave is saying is that you take your money. When you sell the property, you put it into it's called a QI, which is a trust account, as he's talking about. The money goes in there and you have a certain period of days with which to buy another like property. You don't have to buy all of it though. So let's just say you found a property that's $400,000 and you're selling this for $550,000. You can buy the other property for $400,000 and just end up paying capital gains on the $150,000, not all $550,000. Okay, so it's not as cut and dry as all that, but it is a way for you to take your capital gains on rental properties and not have to pay them today. You can kick the can down the road. And as he says, it does take your cost basis and put it in there. So if you have capital gains in this particular case, as he says, what he's done is he's depreciated the property, and all that means is you bought it for $100,000. You've owned it for 30 years, and on your taxes, you've depreciated it, which most landlords do. They depreciate the assets, so they're reducing their taxes, but it also reduces what your balance was. So, like I said, if you originally paid $100,000 for something, but you've depreciated it, what you've done is depreciate your original $100,000. So now it's down to zero. So now you have a property that originally you bought for $100,000, you're going to sell for $500,000. There's a $400,000 gain, but because you've depreciated it, now it's a $500,000 gain rather than $400,000 because you've moved your cost basis from $100,000 down to zero. And again, this is not abnormal. This happens all the time. So if you've done this and you're in this situation and you don't want to pay capital gains on all $500,000 in 1 year and in the quarter that you sold, keep that in mind too. And again, I'm not a tax professional. Talk to your tax advisor. But typically speaking, if you sell something on February 1st of a year, you need to pay that capital gains in that first quarter because that's when you sold the property, which means for a whole year, almost a whole year. But anyway, so if you've got the property, you've got your $500,000 that you're going to pay taxes on, you need to make your intention that, hey, you're going to put this into a 1031 exchange. You put it into your QI, and then from the QI, you can go buy properties out of that. And that's up to you. Now, some people do that, and that's how they continue to buy more and more properties. But when you sell those, again, your cost basis is going to be zero. So if you buy it for $100,000, so you buy two of them for $100,000 and one of them for $3 to make up your $5. If those $100,000 properties end up going up to $500,000, then again, you've got your capital gains scenario. So yes, it does kick the can down the road, but it doesn't really help someone who's wanting to get out of rental properties, doesn't want to be in the business anymore, because otherwise, why are you doing this? If you've already got a property with you're being a good landlord, you've got a good tenant in there, why sell it unless you just, if again, you want the money out of it or you don't want to be a landlord anymore, which, hey, I totally get that. I've done that myself. I've sold properties because I don't want to be a landlord anymore, but that's neither here nor there. So for your situation, if you want to do that. Now, there is an additional situation that you can do on a 1031 exchange. And I'm dumbing this down a little bit, and that's fine. If you need help on a 1031 exchange, give the office a call. We'll be happy to walk you through it. We do it all the time. Or talk to a realtor that understands what they're doing, or depending on your state, because again, you don't want to get into a tax mess with this stuff, because again, you want to do things the right way. But let's just say you've got one of these and you don't want to exchange into another rental property. You just don't want to be a landlord anymore. There is another option with these 1031s that is a 1031 exchange, but you can actually exchange into a like type property without being a landlord anymore. Now, I've got another video I'm uploading on that. Please watch that one if you are interested. Again, give the office a call, because it's a situation where you can actually invest in a 1031 exchange and eventually get into a REIT. So without you having to manage it, some other advantages there. So again, a lot of different options here, a lot of different ways to work on it. One more way for me to try to help you retire when you want to retire and how you want to retire. And I appreciate Dave for bringing this up on his video, but Dickie out.